Welcome to Unlocking the Upside, the podcast where we rethink the mental models driving markets. I'm Jeff Robinson, founder of the investmentanalyst.com.
And I'm James, ex-buy-side analyst, here to keep Jeff's wild theories a bit grounded.
Today, we're diving into George Soros' theory of reflexivity. This isn't just philosophy, it's the secret to understanding why markets boom and bust.
We'll break down how perceptions drive outcomes, why equilibrium is overrated, and what reflexivity means for your investment process.
Markets aren't just about numbers and charts. They're living organisms shaped by our beliefs. And George Soros' theory of reflexivity proves exactly why our perceptions can create billion-dollar realities.
That's fascinating. How does perception actually shape market reality, though? Well, imagine you're watching a bank's stock price fall. People get nervous and start withdrawing their money, which makes the bank weaker, which makes more people withdraw. That's reflexivity in action. The belief in weakness creates actual weakness. So it's like a self-fulfilling prophecy in the financial markets.
Exactly right. And that's what makes Soros' insight so powerful. He recognized that markets aren't these perfectly rational machines like traditional economics assumes. They're driven by these feedback loops between what we think and what actually happens.
You know what this reminds me of? The whole GameStop saga with Reddit traders.
Oh man, that's such a perfect example. The belief that the stock would go up created a buying frenzy that actually drove it up. But here's what's really interesting. Soros developed this theory way back in the 1970s, and it explains modern market phenomena like meme stocks perfectly.
How did he actually come up with this theory?
Well, he was heavily influenced by philosopher Karl Popper's ideas about fallibility, the notion that humans don't have perfect knowledge. Soros realized that in markets, we're not just observers, we're participants. Our actions, based on our imperfect understanding, actually change the thing we're trying to understand.
That seems to go against everything they teach in economics classes about efficient markets.
Right? The efficient market hypothesis says prices reflect all available information, but reflexivity shows how prices can actually diverge from fundamentals for long periods because beliefs and reality are feeding into each other. Look at Bitcoin. Its value is almost entirely based on what people believe it's worth.
So how does this help us understand market bubbles?
Let me walk you through the 2008 housing crisis. It's like a textbook case. As house prices rose, banks thought real estate was super safe. So they loosened lending standards, which let more people buy houses, which pushed prices even higher. The perception of safety created actual demand, which reinforced the perception.
That makes so much sense until it all came crashing down.
And that's another key insight from reflexivity. These feedback loops can work in both directions. When the housing bubble finally burst, the same dynamic worked in reverse. Fear created selling, which created more fear, which created more selling.
So how did Soros use this understanding in his own trading?
His most famous trade, breaking the Bank of England in 1992, was pure reflexivity. He saw that the UK was trying to keep the pound artificially high against the German mark. As more traders questioned whether this was sustainable, they started selling pounds, which made it even harder for the UK to maintain the exchange rate.
That's incredible. He made like $1 billion on that trade, right?
Actually closer to 2 billion. But here's what's fascinating. He wasn't just betting on economic fundamentals. He understood that once enough people believed the pound would fall, their actions would make it fall. It's like he saw the future by understanding how people's beliefs would shape it.
Well, that explains why they call him the man who broke the Bank of England.
You know what's really interesting, though? This isn't just about financial markets. Reflexivity shows up everywhere in society. Think about how company valuations affect their ability to raise capital, which affects their actual performance, which affects their valuations.
So it's like a continuous feedback loop between perception and reality.
Exactly. And in today's world of social media and instant global communication, these feedback loops can happen faster than ever. A tweet from Elon Musk can move markets in seconds because people believe it will move markets.
That's pretty mind-bending when you think about it.
And here's another layer. Central banks now explicitly try to manage market expectations through forward guidance. They're basically using reflexivity intentionally. They know that what people believe about future interest rates affects economic behavior today.
So what does this mean for individual investors? How should we adapt our strategies?
Well, first it means being humble. Recognizing that markets are reflexive means accepting fundamental uncertainty, but it also means paying attention to narratives and sentiment, not just numbers. Sometimes the story people believe about an asset is more important than its fundamentals.
That sounds pretty challenging. How do you actually do that in practice?
Look for situations where perception and reality are reinforcing each other. For example, when a company gets added to the S&P 500, its stock typically rises not because anything fundamental changed, but because index funds have to buy it. That buying pressure creates momentum, which attracts more buyers.
So it's about identifying these feedback loops before they become obvious to everyone?
Exactly. And understanding that they can work both ways. The same forces that drive prices up can drive them down just as dramatically. That's why Soros always emphasized the importance of recognizing when a trend might be about to reverse.
This really changes how you think about market analysis, doesn't it?
Completely. Instead of just looking at PE ratios or growth rates, you have to think about the narratives driving market behavior and how those narratives might evolve. It's more like studying psychology than mathematics.
That must be why technical analysis sometimes works. It's capturing these feedback loops in price patterns.
Now you're getting it. And here's something else to consider. Reflexivity explains why markets often overshoot, both on the upside and downside. When everyone believes something will go up, they buy, which makes it go up, which confirms their belief until suddenly it doesn't.
So what's the biggest lesson for investors from all this?
I'd say it's about embracing complexity. Markets aren't mechanical systems that can be perfectly modeled. They're more like living organisms that evolve and adapt. Understanding reflexivity means being comfortable with uncertainty while still looking for patterns in how beliefs shape reality.
That's quite different from the traditional view of rational markets reaching equilibrium.
And that's exactly why Soros's insights are more relevant than ever. In a world where information moves at light speed and narratives can change instantly, understanding how perception creates reality isn't just helpful. It's essential for survival in the markets.
This has really changed how I think about market behavior.
You know what's really powerful? Once you start seeing reflexivity in action, you can't unsee it. It's everywhere, in market bubbles, in currency crises, in how companies raise capital, in how central banks manage expectations. It's like having a new lens to understand the financial world.
And probably why markets will always be more art than science.
Exactly right. And that's perhaps Soros's greatest contribution, helping us understand that markets aren't just processing machines, they're mirrors of human psychology and behavior. And in that reflection, we can find both danger and opportunity. Before we wrap up, I want to tell you about something close to my heart. After decades in the investment trenches, I created Insight One, a platform that fuses real institutional analysis with cutting-edge learning technology. Whether you're an aspiring analyst or a seasoned investor, Insight One brings market mastery to your fingertips. We're available now at theinvestmentanalyst.com or your favorite app store.